This is why they want you to look at the Dow Jones. And by the end of this video, you're going to understand exactly why the narrative around specific indices matters more than you think. We're also going to talk about a massive rotation happening right now in the AI infrastructure space and why smart money might be moving from one name into another that has deep connections to the biggest player in the AI game. But first, we need to understand what's really happening beneath the surface of these market moves. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily live streams on market analysis that cover any questions you ask in the Discord community, try my Discord, the Stocks Community, for just $25 for 7 days at stockscommunity.com. If you're looking for a free resource, head over to free.stockscommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involves government figures and their stock portfolios, which YouTube can sometimes restrict on its platform. The link is in the description below. As always, this is not financial advice. Do your own research. But here's the thing. The markets are selling off. Gold and silver are collapsing at rates we haven't seen in over a decade. Bitcoin is getting hammered. And you're being told to focus on one thing, the Dow Jones Industrial Average. But here's what they're not telling you. When you look at the major indices right now, something fascinating is happening. The S&P 500 has already broken its key support levels. The NASDAQ broke its uptrend weeks ago, but the Dow's been holding up better than both of them. It hasn't broken its critical trend line from the April lows yet. Now, why does this matter? Because the Dow is filled with defensive names, Home Depot, Microsoft, even Walmart, which just hit all-time highs while the rest of the market is bleeding. These are old school companies that people perceive are safe. And when you see headlines talking about the strength of the Dow while ignoring the weakness in the broader market, you need to ask yourself, what are they trying to tell me? Or more importantly, what are they not telling me? The Dow is more defensive by nature. It's 30 large established companies. Meanwhile, the S&P 500 and NASDAQ, which are broader and more tech-heavy, are showing serious weakness. The S&P is down from its parallel channel that's marked highs and lows since COVID, and the NASDAQ already topped out and it's been making lower highs. But they want you looking at the Dow because it makes the picture seem less dire than it actually is. So think about it from a technical perspective. When you have a market where the NASDAQ has broken trend, the S&P has broken support, but the Dow is still hanging on by a thread, that's not strength. That's a rotation into safety before a final leg down. It's the last domino waiting to fall. So let me break down what the charts are actually telling us, because the charts don't lie. They don't have a political agenda. They don't have a narrative to push. The chart is the chart. Starting with the S&P 500, we had this beautiful trend line from the April lows. The market bounced off it multiple times, each bounce getting smaller and smaller until it finally broke. Then we got a retest of that trend line from below, which is a classic technical setup. And now we're selling off hard. And this is textbook distribution. And that's when retail investors, driven by FOMO and the buy the dip mentality that's worked for years, keep piling into every dip. They've been conditioned by the V-bottom recoveries like COVID or the tariff sell-off, the August 2024 drop. Every single time it came roaring back. I mean, September was crazy. So they're trained like Pavlov's dogs to buy every dip. But who's selling to them? Institutional money, big money, smart money that knows these valuations are stretched and knows the fundamentals don't support these levels. So when you look at the chart and you see this, it's buying pressure pushing the market up, then it's selling, selling, selling as it struggles to make new highs. And it's forming a rounded top distribution. Retail is buying and the institutions are dumping their shares right into retail's hands. So over the last 8 sessions, even 115 stocks in the S&P declined by more than 7% in a single day. We haven't seen this kind of action since the dot-com bubble burst. And the average drawdown when this happens is 34%. We're currently only 2% below all-time highs. So it's legitimate. Now let's talk about the jobs report. Just came out, because this is where things get really interesting this week. The headline number beat expectations by nearly double. Unemployment ticked down from 4.4% to 4.3%, but every single data point was exactly 1/10 better than expected, every single one. And if you're like me, you're a little suspect of that. So when have you ever seen a report where every metric beats by exactly the same margin? It's almost too perfect. But the administration's been preparing everyone for a bad number as well, which caused the market to sell off before the release. Then when the strong number came out, what happened? The market rallied initially, but couldn't hold its gains. And that inability to hold gains after supposedly good news, that's a telltale sign. Big money knows better. They know that retail buyers are buying this. They're selling into the news. Retail saw the headline and thought, economy strong, buy stocks. But here's how you really know the smart money doesn't believe it. Look at the bonds. The 10-year Treasury yield was dropping going into the jobs report. After the strong number that should have pushed yields higher, what happened? Yields actually closed lower. And the next day, even lower, back to 4.11%. The bond market's way bigger than the stock market. Way, way bigger. And bond traders are not buying that the economy is as strong as this jobs report suggests. They're buying bonds, which pushes yields down because they're worried about economic weakness ahead. Let's dig into what the jobs report actually showed beyond the headline. Most of the jobs growth came from healthcare and social assistance. Healthcare alone accounted for the majority of new jobs. Now, why does this matter? Well, different sectors grow at different speeds in terms of productivity. Tech, manufacturing, and finance tend to drive a lot of economic productivity. How much output you get for the same amount of input? Well, healthcare and social services, they tend to grow much slower in productivity terms. So if most job growth is happening in lower productivity sectors, the economy can look strong on the surface while underlying growth stays weak. You're adding jobs, but the economic impact of those jobs is lower. There was even a graphic going around showing that if you exclude healthcare employment, the US has actually lost jobs since 2024. There's nuance here. Government jobs have been declining, which some argue is actually good, because public sector jobs paid with debt can be a drag on productivity and growth. The idea is that guys didn't want me to use cough drops. When the government can run deficits to pay for jobs, it issues more treasury bonds, which increases demand for loanable funds and can crowd out private sector investment. The Congressional Budget Office estimates that for every additional dollar of federal deficit, private investment falls by about 33% on average. So government spending can displace more efficient private sector activity. And with government jobs declining while private sector jobs grow, that should mean growth is moving to more productive places. But, and this is important, we also saw that healthcare was a major part of the job growth increase, and that's not the highest productivity sector either. So the picture is complicated. Meanwhile, credit card debt keeps hitting new record highs. People don't want to lower their lifestyles, so they're spending money they don't have. Walmart, Target, and Kroger have all reported that consumers are trading down to cheaper brands because things are getting more expensive. And when you see Walmart hitting all-time highs while the rest of the market struggles, that's not a good sign for the economy. That's a sign people are struggling and looking for value. Here's what you need to understand about inflation that nobody teaches you in school. Inflation is a compounding number. When you hear that inflation's 3%, it doesn't mean prices have fallen. It means the rate at which prices are rising is lower than before. Prices are still going up. They're just not going up as fast. So that 3% in 2026 is on top of the price growth from 2025, which is on top of 2024, which is on top of 2023, which is on top of that 9.1% we saw in 2022. It compounds. And this isn't new. The Fed has publicly stated they have a goal of 2% inflation, not 0%, 2. Why? Because in this system, inflation benefits asset prices. It benefits stock prices, real estate prices, other asset values. But wages haven't kept up with inflation for decades. Look at the number from 71 to 2021. Median incomes grew by about 600%. The price of a new car grew by 800%. The median house grew by 1,200%. College costs went up 2,000%. So yes, incomes went up, but not fast enough to keep up with the cost of living. After the pandemic, this accelerated. Between 2020 and 2025, reported CPI inflation was about 23.5%, reported wage growth about 21.8%. So even by the official numbers, inflation outpaced wage growth. But here's the kicker. CPI doesn't tell the full story. It's a basket of goods averaged together, but it includes things you buy rarely, like cars, furniture, TVs, houses, and underweights things you buy constantly: groceries, gas, health insurance, rent. The rule of thumb on the internet now is to take CPI and multiply it by 2 to get closer to real inflation. So CPI says 3%, real inflation for most people feels like 6%. And if your savings aren't growing by 6%, you're losing purchasing power. If your income isn't growing by 6%, you're getting poorer each year. Every time you spend $1, somebody else makes $1. When inflation happens and you have to pay $15 for something that used to cost $10, the workers might get a small raise, but all those extra dollars go to the investors, the people who own the businesses. Inflation makes consumption more expensive for you, but it makes the businesses more profitable for their owners. This is why becoming an investor is so critical. If you're just earning a salary and saving cash, and that cash is losing 6% of its purchasing power every year while your salary grows by 2%, you're on a treadmill running backwards. So where are we going from here? The charts are telling us we're likely seeing a multi-day sell-off, not just a one-day event. First target on the S&P 500 is 65.25. The major support level is down at 6,100. That's the former high from December 2024 and early 25 before that massive dip. The level is critical because when we broke above it, it established a major support. Now, if we break below it, that's a problem. The NASDAQ has similar issues. The parallel channel that's marked highs and lows since COVID shows we're at the high end. When you're at the high end of that channel with massive resistance above and lots of downside to support below, the risk reward is terrible. Maybe 1 to 2% upside versus potentially 15 to 20% downside to the next support level, around 17,000. The Dow topped right at that even 50,000 level, a psychological resistance point, and it's been rejected multiple times. Once it breaks that trend line from the April lows, watch out below. The minimum target could be 49,000. But if it breaks with conviction, the floodgates open. This is classic technical analysis. When you see a stock struggling to make slightly higher highs, or a whole market forming around the top, with each bounce getting smaller and smaller before it breaks support, that's distribution. That's smart money selling to dumb money. And once those key levels break, the selling accelerates. Now, here's where things get really interesting for those paying attention. While the broad market is showing this weakness, there's rotation happening in the AI infrastructure space that you need to understand. We've seen DigitalOcean have an incredible run recently, but now smart money appears to be rotating into Nebius, and there's a very specific reason why. Nebius has deep structural connections to NVIDIA. We're not just talking about being a customer or a partner in the traditional sense. The relationship's more fundamental to the AI infrastructure build out. And when you see money flowing from one AI infrastructure play into another that has those kind of ties to the biggest GPU manufacturer in the world, the company that's essentially the arms dealer of the AI revolution, you need to pay attention, especially in a market environment where capital is becoming more selective and flowing towards names with the strongest structural advantages. So what did I miss here, and what would you push back on? Let me know in the comments. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily 15-minute recordings of market analysis every weekday the market's open, head over to stockscommunity.com. Join my Discord for just $25 for 7 days. Plus, if you want market updates I can't share on YouTube, sign up at free.stockscommunity.com. If you found this valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it. This isn't financial advice, but when you're seeing broad market weakness and specific strength in names with these kind of connections, it tells you where smart money thinks the real value is. It's not about chasing the Dow because it hasn't broken yet. It's about understanding where capital is actually flowing beneath the surface. The charts don't lie. The rotation doesn't lie. And right now, both are telling a very specific story about where we are in this market cycle and where the opportunities might be for those willing to look beyond the headlines about the Dow Jones Industrial Average not breaking down yet. So stay safe out there, protect your capital, and remember, the only unbiased thing in this market is the chart itself.